Hey everyone, Evan Shweky, CEO of Delarosa Lending Group, hard money lenders, multifamily, commercial, and fix and flip real estate investors. I want to talk to you about 5 alternative ways you can invest in real estate with no experience starting today. There are literally hundreds of real estate investment opportunities for investors to choose from. Picking the right investment vehicle can be a daunting task, so I'm going to keep it simple and help alleviate some of the stress. Studies have shown the greater the number of retirement investment options available to employees, the likelier it is that they fail to select any of the options presented. We don't want that to happen. We'll briefly discuss 5 types of real estate investments you should consider now that you're contemplating becoming a real estate investor. The first 2 types of investments I'm going to discuss are considered active investments because you will own the real estate and actively participate in generating profits from those properties. These active investments typically offer the highest returns but come with greater risk. The other 3 investment options are passive investments. In those instances, you will simply write a check and let the professionals create the value for you. Much of the decision-making involved in deciding which type of real estate vehicle suits you will be based on your real estate experience, risk tolerance, liquidity, and time availability. Investing in fix and flips and flip to rent properties are the 2 active investments I'm referring to. By now, you're all familiar with the myriad of reality flip shows like Flip or Flop, Fixer Upper, and the ever-charming Property Brothers. Despite these shows being scripted for your entertainment, you can legitimately make good money buying a property in need of rehabbing, whether it's a side hustle or a full-time business. 6% of homes sold in the US in 2019 were flips. That was an 8-year high. In reality, buying, rehabbing, and either selling or renting a dilapidated property involves a lot of patience and planning. As a hard money lender, we generally see flips taking 6 months from start to finish, rather than the 6 weeks you see on TV. This market is still ripe with room for investors to continue making profits, particularly taking into account the current housing shortage and low interest rates for mortgages. You'll probably need to make an equity investment of anywhere from $20,000 to $50,000, depending on the property's value. Profits from the flips can be in the tens of thousands of dollars. These high returns are made possible by using a private lender or hard money lender to leverage your equity in the property. These lenders can finance the majority of the purchase price and 100% of the renovations. We will be talking more about the financing aspect of flipping, as well as how to get a flip done with little or no money, and that's a hard thing to do, in some upcoming episodes. If you prefer building a rental portfolio but don't want to deal with rehabbing the property, you can ask your realtor to find turnkey properties with tenants already in place. You can try to manage these properties on your own, or for a small percentage of the monthly rent, you can hire a reputable property management company to manage them for you. The main advantage with rentals is that rental incomes are steady, unlike volatility in the stock market. For example, this past March, the stock market fell off a cliff and was down over 30%. A tenant paying $1,200 in rent in March was still paying $1,200 a month in April. It wasn't reduced to $850 to reflect the stock market volatility. Another advantage of investing in rentals is that annual rental increases will normally outpace the rate of inflation. Reaping the benefits of these investments requires you to put in a lot of your own personal time. It's not so easy to do all of this if you already have a full-time job. And there are always risks associated with selling a property once it's rehabbed, if it's a fix and flip, or finding renters and maintaining a rental property for the fix and hold investor. In a typical scenario, you will need an investor-friendly real estate agent, a lender, as well as a general contractor to get your active investment off the ground. You might want to check out our video on what to look for in an investor-friendly real estate agent and where to find them, and our video on how to find a reputable general contractor at our Swipe Left for Success YouTube channel. In either scenario, you need to understand the math behind both of these investments. That means accurately accounting for all of the expenses that will be incurred in completing the project. Finding an accountant or someone experienced in rehabbing or renting real estate will be helpful in making sure all hard and soft costs associated with the project are accounted for. So, we briefly touched on two different types of active investments. The main point I wanted to make with respect to those options is the extensive time commitment involved. The passive investment options I'm going to now talk about allow you to sit back and collect profits without the time commitment and stress associated with an active investment. Syndications are a passive investment. Money is pooled from many different investors and used to acquire high-priced properties from different real estate asset classes. Some examples of the types of properties that are part of syndication deals include office buildings, multifamily, mobile home parks, and self-storage facilities. These properties are either acquired and held for the cash flow, or the sponsors of the syndication may implement a value-add strategy to raise the property's value. In many cases, a deal will encompass both strategies. As the investor, you directly own a percentage of the property itself in the form of a limited partnership interest. Under this arrangement, the investor typically receives a portion of the profits from the operation, as well as the sale proceeds if the sale of the property is part of the exit strategy. The transactions are run by syndicators, also called sponsors or general partners. Syndications are highly regulated and only open to accredited investors with minimum investment requirements of $50,000 or more. You should only invest with a reputable team of sponsors who have a track record of success. Unlike active investments, investors participating in syndicated deals have no decision-making control relating to the deal, and their money can be tied up for years. The investment can remain illiquid until the property is sold, at which time profits are distributed. An investor who needs to exit a syndication early may have to accept a significant discount to the original investment in order to withdraw funds. Patience is a prerequisite for this type of investment. The buy-in may seem steep, and the lack of control or ability to take your funds out may seem a little disconcerting. However, the above average annual returns, and we're talking anywhere from 15 to 50% annually, far outweigh the risks. Real estate investment trusts, commonly referred to as REITs, are another passive investment to consider. REITs own, operate, or finance income-producing real estate. Most REITs are traded on the major stock exchanges, so to buy shares in a REIT, you simply have to open up a brokerage account with as little as $100 to purchase shares of your favorite REIT, like you would when you buy shares of your favorite companies like Apple or Microsoft. They can be sold in a moment's notice as well, unlike the time necessary to sell a fix and flip. There are different types of REITs covering 13 types of real estate asset classes. REITs are required to distribute 90% of their proceeds in the form of dividends. REIT total return performance over the past 20 years, which includes dividends and stock appreciation, has outstripped the performance of the S&P 500 index. Adding REITs can be beneficial in diversifying your portfolio if you don't already own any investment real estate or individual real estate stocks. The risks are similar to those of stocks. In the stock market, if the underlying business is not doing well, the stock price will go down. As an example, REIT stocks in the retail space have taken it on the chin because of the pandemic, as retailers like Gap, Bed Bath & Beyond, and AMC movie theaters stopped paying their monthly rent. So while the commercial retail REITs have done poorly, REITs that invest in cell towers are killing it. Make sure to find out what the underlying real estate asset that the REIT is investing in before purchasing any shares. The final passive investment I want to mention is private lending. Private lending is a vehicle used by fix and flippers to purchase or renovate real estate. As a private lender, you, as a lender, are like a bank, lending money at a predetermined interest rate and maturity date to the rehabber, who is the borrower. That's exactly what we do at Delarosa Lending Group. The borrower will give you a promissory note that should be secured with a mortgage on the borrower's real estate holdings. You will then receive monthly interest payments in exchange for the loan. The interest rate can be whatever the two parties agree on, but typically range anywhere from 8% to 18%. If you're uncomfortable acting as your own private lender, you can always contact a hard money lender and ask them if you can invest in their mortgages. You might get a slightly lower interest rate, but you won't have to deal with any legal paperwork or monitoring of the project, and you can be sure those firms have vetted out the borrower's creditworthiness and the property itself. If the borrower defaults on the note, you will be able to foreclose and take possession of the collateral. From day one, you will know both the time and the dollar amount you will be paid on the loan. Some of the greatest fortunes have been created by some amazing individuals who literally started from the ground up. Real estate is all around us. The opportunities are boundless. In a strong real estate market as well as a weak real estate market, there's always opportunity. We just have to continually educate ourselves and always keep our eyes open for those profitable opportunities. I know I threw a lot of information your way for this episode. Today's information is a great start in getting the education necessary for building wealth through real estate. Thanks for tuning in. If you really like the show, please tell your friends about us and subscribe to our YouTube channel at Swipe Left for Success. Stay tuned for new weekly episodes offering real estate investors and entrepreneurs practical advice and ideas to help you grow your business and achieve the success you envision. Let us know about any topics you'd like us to explore in the comment section below. We are listening, and we'll see you at the top.